Good evening. Please rise and join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Oh, no, this is for Larry's.
Good evening, everyone. This is the regularly scheduled meeting of the BET for November 2009. Before us, item number 2, consideration of applications, routine applications. Madam Clerk.
Yes, good evening. We have PS1, parking for parking services, an additional appropriation of $18,000. HD4 for health, approval to use $73,007.78. ED4 for the BOE, a transfer of $500. And I so move these routine applications.
Moved by Ms. Tarkington, second by Mr. Mason. Discussion? All those in favor?
Aye.
Opposed? Abstention. Is it 11, sir?
11, I think. Mr. Raymer, something?
Mr. Raymer is, I believe, still recuperating from
He is.
surgery.
He is.
Item 3 now comes before us, Assessor's Report. Mr. Gwartney, our Town Assessor. Good evening.
Good evening, Mr. Chairman and members of the board. You have my report in front of you. I'd be glad to entertain any questions.
Questions for the Assessor? We will be taking up under old business the approval of the reval for 2010, so I would ask that you limit your questions to those topics outside of that one. Mr. Finger.
Approximately 3,000 of the 4,400 annual declarations will be returned. What happens to the other 1,400 when they come in late? Is there a penalty? What kind of follow-up is there?
There is a penalty which increases their assessment by 25%.
Thank you.
Other questions for the Town Assessor? Ms. Barton?
Ted, I notice you have changed the format, I think at our request from the last meeting, for litigation involving Superior Court cases arising out of the reval. And I was a little concerned by the percentages that you showed on that chart until I realized that you're reporting only the challenges and not the great majority of taxpayers who don't challenge. And I wonder if you could tell us how the results of the challenges affect the ultimate taxes of the town, which I think is more what I would want to know going forward. How much money are we losing by virtue of these revaluation challenges?
The results of all the changes that have been made over the last 4 years amount to a total of 0.39 of 1%, 39 hundredths of 1%. The total amount of dollars reduced as a result is $181,512,000, which basically divided by the 100% value would mean that it's less than 0.5%.
Less than 0.5% of taxes are lost to changes in the valuation.
Yes.
Thank you.
Further questions?
Mr. Chairman.
Mr. Campbell.
Just so long as we're on that point, Mr. Gwartney, if I read it correctly, just in the total reduction column that you have there, do I read it correctly where it says total reduction is $181 million, roughly?
Yes.
So could we just say then that means that the cost is that 1.5, 1.6 million a year? Is that in taxes? Is that what's been reduced in our tax revenue?
That represents the total reduction in full market value. So the taxes would be 75% of that times the mill rate.
Or 70% of that times
70%.
Okay, so even less than the number I'd say, closer to $1 million a year. Okay, thank you.
Further questions for the assessor? Hearing none, is there a motion to accept the assessor's report? Moved by Ms. Tarkington, second by Mr. Mason. Discussion? All those in favor? Opposed? Abstentions? 11-0-0. Thank you, Mr. Courtney. BET Committee and Special Project Team reports. You should have in front of you the Audit Committee report, the OPEB Trust and Ad Hoc OPEB Committee reports, Nathaniel Witherell Building Committee report, Human Resources Committee report, and the High School Auditorium report. Also at this time, Mr. Norton has asked to be recognized to discuss the Glenville School Building Committee report.
I didn't prepare, Mr. Chairman, I did not prepare a written report for this month for two basic reasons. Number one, the TCO was granted by the building department approximately 2.5 weeks ago, and we meet tomorrow, and one of the items on the agenda for tomorrow is returning the building to the Board of Education from the Building Committee, and the Building Committee going out of existence. I think we'll proceed with that because the intended occupancy is later this month.
Question, Mr. Finger?
You mentioned that we should have had a Greenwich High School auditorium report. I did not have one in my packet.
Maybe I'm just reading off my agenda and didn't see that it's not. How about we just ask Mr. Kelly to give us a report on that?
Yes, we're moving forward on that. We're submitting to planning and zoning. I believe it was this week or next week, the actual documents. I will give you full written reports from now on at these meetings.
Further follow-up. Mr. Kremick?
Mr. Kelly, is it correct that I heard the selectmen gave the project municipal improvement?
That's correct.
Status?
That is correct.
So that's significant.
That is significant.
Further discussions on any of the reports? Okay, item 5 now comes before us, the Comptroller's report. Our Comptroller, Peter Mynarski.
Good evening, Mr. Chairman, BET members. The flash report was a little late, and it's a copy was emailed on Saturday morning, and you have copies in front of you. I will answer any questions on the Comptroller's report at this point.
Questions for the Comptroller? None. I will say at this point that, well, I'll save it for my comments at the officer's report. It fits better in there relative to shared services. Any other comments for the Comptroller? Is there a motion to approve his report? Moved by Ms. Tarkington, second by Mr. Finger. Discussion. All those in favor?
Aye.
Opposed? Abstentions? 11-0-0. The treasurer's report should be before you. Discussion on the treasurer's report. Mr. Norton? Move to accept the treasurer's report by Mr. Norton. Is there a second? Second by Mr. Simon. All those in favor?
Aye.
Opposed? Abstentions? 11-0-0. Item 7 now comes before us. Approval of BET minutes for October 19th, 2009. Discussion. Mr. Simon.
Just one second. So when we approved the consultant to do the study for Nathaniel Witherell, which is where I'm looking for in this minutes, this was not really an application, was it? This was. No. We did for the shared services. Thank you.
What page are you referring to?
On page 5. No, for the shared services. That wasn't an earlier draft. 9. Thank you. Great. All right, there we go. I found it, regarding the RFP. So we basically agreed to approve. I'd sort of withdraw the question. Whether we agreed to expend the money in the budget for this purposes.
That's correct. Money that was previously budgeted and appropriated within the Finance Department's budget of $50,000.
An audit for the audit committee.
Okay, thank you. I had no other questions.
Any other questions on the minutes? Here's our motion to approve the minutes.
So moved.
Moved by Mr. Simon, second by Mr. Norton.
You'll get there soon enough.
All those in favor? Opposed? Abstentions? Mr. Mason abstains. 10-0-1. Officers report. Mr. Stone?
Nothing, Mr. Chairman.
Ms. Tarkington?
I have nothing to report. Thank you.
This month was a busy month in terms of work that was done, as you all know, and as you all do, I'm sure, on a daily basis. Part of what we do up here is help educate our fellow citizens as to the budget process and what it is that we do. I had the fortunate opportunity to speak before the First Friday group last week and present not only I gave an overview of our 100 years, but also where our budget ended up last fiscal year and some of the issues that we're facing in the coming year. I think it's important to get that information out to the public, and in fact, they had some ideas for us, some better than others, but nonetheless, in fact, there's been a series of follow-up emails and conversations regarding a group of individuals who've had some experience in the shared services areas and have offered their advice and counsel. So I'll be taking them up on that request. In fact, later on this week, I will be joining the First Selectman in speaking before the Northeast Greenwich Association, and once again presenting at their annual meeting where we are with the town budget. And then I believe in January, it's been requested that I appear before the Riverside Association to again discuss town affairs. It's been requested, and as I stated at last month's meeting, certainly before the election, but now that the election has taken place, a review of the tax collector's office and its personnel. At this point in time, I think that such a review of that office should occur after we go through this next budget cycle to give the soon-to-be installed tax collector an opportunity to review his budget and then to come back with suggestions on his own. But if you have any thoughts on that point, I'll take them at any time. If you think it should be part of this year's budget, certainly let me know that. But if not, the plan at this point would be to take up a review of that office after we finish with our budget process in the sort of April-May timeframe. Mr. Kremick.
I probably won't be on the board when you finally take this up again, but it seems to me one of the things that needs to be done is I've heard some talk about possibly eliminating it or reducing the compensation. I think the law department should be tasked with investigating the legal authority to do that on an elected position. I think that creates a little different circumstance than what we normally deal with respect to changing a position in town government. And I just throw that out for whatever it's worth. I see Gene McLaughlin's in the audience. But I just think that would be important to look into.
Okay, so you're talking about getting an analysis or an opinion regarding whether or not we even have the authority to do such a review and or make changes, and that can be done sooner rather than later and not necessarily have to wait until the April-May timeframe.
That's right. That's right. I think it's a different and a trickier situation than we would normally face in dealing with paid position in our table of organization.
Okay. Thank you for your comments. I don't know if anybody, switching topics here, I don't know if anyone else saw the recent CCM circular regarding shared services, but I will circulate that through the Finance Department. And in essence, it states that various towns are looking at shared services, are looking for those efficiencies regarding having having two of whatever function they were talking about, whether it be print shop or accounting or HR. So clearly, other municipalities are looking into this, and certainly it's a topic that we are looking into. Remind you again that the biennial dinner is December 9th. If you have not already responded to Mr. Simon, who once again let me thank for organizing this event, please do so. Not only this year are we celebrating both Mr. Crummick and Mr. Stone's work on the BET, but also celebrating our 100 years. Lastly, I want to first congratulate the first selectman on his re-election. Congratulations. And in the audience today is Drew Marzullo. Also, congratulations to you. But also, because of the way our election cycle works, this is the last meeting that Mr. Crumbine will be before us as selectman, also who served on this capable body and before he became our selectman. And so with that, would you please join me in a round of applause for Peter Crumbine?
I was interested in how he was going to describe us. I heard how he described the RTM.
Well, you'll certainly be missed. We think that Mr. Marzullo and Mr. Tice will do a fine job, but not seeing you in that chair will be surely missed. That is all I have for an officer's report. Moving on to 9, old business. Probably the first major topic of discussion for this evening, the approval of the senior tax deferral ordinance. With that, I don't know who's presenting this. There's a whole cadre of town personnel here. I see Sam Deibler. Good evening. Mr. First Selectman, certainly.
Good evening. As you know, the Board of Selectmen at our meeting last week, Tuesday, we changed our meeting dates around, adopted this proposal unanimously. We did so after receiving considerable input from members of the committee, and I do want to applaud the members of the working group who deliberated, I believe, since late spring, early summer on coming up with this proposal, and many of those individuals are in the room tonight, as well as Ms. Barton, who was part of that, and Mr. Campbell, you initially were part of it, but unfortunately could not remain with us, but you're with us in spirit. But Ms. Barton and so many others who worked to put together the proposal that ultimately the Board of Selectmen acted upon. And simply, I see this as an option that will provide seniors to defer a portion of their property taxes, in addition to the credit. So it's an either or as it's drafted. And I think it's a good first step, again, into providing our senior population a choice that is available under Connecticut general statutes. So, again, I want to not only endorse the proposal that's before you, as did my two colleagues, but also, again, thank all those who participated in countless meetings. And Mr. Crary, our town administrator, chaired that, and I would be remiss if I did not thank him because, frankly, he brought forward the proposal to the Board of Selectmen. So thank you, Mr. Crary.
Mr. Simon.
Yeah, I think it would be helpful. You know, we have many versions of this document, of which, if they actually use the footer and label them, we may all be on the same version. To at least reiterate where we are in the process from the Budget Committee, because the Budget Committee did pass a version of this document. And I assume that everybody The easiest way to tell if we have the most current document is to look on paragraph 2 on page 5. It should have the words "the Federal Reserve statistical release" in it. That, I believe, is the most current version. I think we should all work from the same document.
Okay.
So, and after the Budget Committee met and approved this, we added, there were 2 changes made to this document after that date, one of which is on the top of page 4, which I guess, Gene, we basically asked the question as to whether or not a trust can apply for and receive a deferral, and I believe the answer came back no. And that's what the top of page 4 says, that you must be an individual to receive a deferral. And the town attorney or anybody else can comment on that change. And then on the bottom in number 10, Mr. Campbell's suggestion, which I thought was a very good one, we added the words "each of the prior assessment years" to make it clear what the assessment limit was. This would be on the 4th line of number 10. Those are the 2 changes that were made as a result of the Budget Committee meeting. And we can then vote and discuss those separately. And then in addition, Mrs. Tarkington made some excellent suggestions in number 2. What makes the process more difficult is I don't know all the changes that were made as a result of her requests. So I can see all the changes that were, if all the changes are in paragraph 2 on page B2, that would make the discussion simpler. If there are other changes, I would like to know that.
Mr. Kremick.
Just with respect to the language about the applicant not being a trust, as I understand the response from that were drafted by Gene McLaughlin, although the applicant cannot be a trust, the applicant can qualify if they're a beneficiary of a trust. Am I correct in that?
The way the program has developed under the credit.
My name is Gene McLaughlin, Assistant.
And just so it's clear to everybody, what we're talking about is senior tax relief that seniors who own property and meet certain income limits can qualify for a tax break. That's basically what we're talking about here.
Thank you. The way the program developed under the credit was that trusts, people were coming in with trusts that they had done for various purposes, I suppose for estate planning or for ease in administration and probate. So instead of individuals necessarily coming in, we had the assessor had trusts coming in. He sought information from the State of Connecticut Office of Policy and Management, and that body gave him some printed material that basically said if it was clearly identifiable that the beneficiary of that trust was a qualifying taxpayer, that it was proper to give tax relief for the credit to a trust. This new program that we're adding, which is the deferral, which has the recapture on the death of the taxpayer, presents some problems if there's a trust. So on the deferral side, we made an amendment that a trust will not qualify for treatment for the deferral. It would be too difficult to figure out who was the trust and whether they died or not. So we made a specific amendment based on some questions that were asked that a trust will not qualify for the deferral part of the program. It would just be too difficult to do that.
So it'll continue to qualify for the credit program if the taxpayer had their property in trust, but not for the deferral program.
That's correct.
Thank you.
Before we proceed with the merits of this topic, first let me welcome Boy Scout Troop 10 of Koskob. Good evening. I guess we beat out the RTM and the Board of Selectmen for the meeting that you attend, so I don't know how we should view that, but welcome. If at any time any of you have any questions, if you just raise your hand, I'll be more than happy to ask you to just step up to the podium and feel free, especially if you don't understand this topic, which I suspect is not the sexiest of topics for you. We're moving on to even something even more intriguing, which is the revaluation. So hopefully you can bear with us as we work through this, and hopefully you gain something from it, even if it's not the actual merits of the issue, but the process that we're going through. So thank you for coming. Ms. Tarkington.
I just respond through you, Mr. Chairman, to Mr. Simon's question. The points that I raised are all in point number 11B, tax deferral, number 2. And the points which I raised are just defining the index which will be used for borrowing, which is using the Federal Reserve Statistical Release Index, saying what happens if July 1st happens to be on a Saturday or Sunday. It's the first business day thereafter, and also finally saying that that any deferred taxes may be repaid in whole or in part at any time without penalty, and they're all within that one paragraph, which is paragraph 2.
Further comment, Mr. Simon.
Yeah, so should we, do you want to, I have comments on the last part of that paragraph that was changed. Other than that, maybe I should just go right to that point.
Okay, so here's how I would like this to be presented. I think as we normally have presented items before, the version that was voted on by the Budget Committee will be the version that's before us. If anyone wishes to amend it, so for instance, Ms. Tarkington's paragraph 2 amendment, I'm going to ask her to actually move that portion to be amended, and so we'll take it up from there. The Budget Committee's recommendation should be the version that we work off of and make amendments to that document. Does that make sense?
Yeah, well, then we would
The
have
same
to,
is true for the trust provision. That was not adopted at the Budget Committee. It was a suggestion that it be looked at further, but it didn't come into the draft until we got one after the Budget Committee.
That's correct.
So if we're going back to the Budget Committee draft, I have no idea what draft we're working from.
that's a problem with the way in which we document these. I have the Budget Committee draft, but no one else, I don't know if other people do.
Well, if everyone's then working off of the draft that has all of the changes to it, we could simply make amendments to that one and take it from there.
I think we can remember the important parts that were added after the Budget Committee. If there's any disagreement about that, we can sort it out, but
Well, I think we already highlighted
I think the two major
most of
ones-
them anyway.
Yeah, at least the two major ones have been highlighted, and they can be framed in the form of a motion, but I'm troubled by trying to go back and find an earlier draft and work from that.
So we'll work off of the draft that's before you. If you wish to amend it in any fashion, then you need to move to amend it, whether it's adding or deleting from that. Most importantly, Maria, do you understand that? Okay, thank you. Are there any comments or suggested motions for the draft that we received today?
I have one.
Mr. Simon?
So now the draft for today is the one that includes Leslie's changes, right?
Correct.
All right, so the only thing I would like to change is on the last sentence, number 4, the cumulative amount of deferred taxes plus interest may be repaid in whole. I don't know that we want to be, I don't think we should let people repay it in part. We don't want to be in the business of somebody coming in and paying $100, $200, $300. It becomes an administrative nightmare for us to take these deferrals and then have partial payments. That's one part. I don't think they need to give us 5 days written notice that they're going to repay it. And 3, there are no penalty provisions in the document anywhere, so without penalty implies that there's penalty somewhere else. Or if you can or that's my own feeling, that people shouldn't be allowed to come in and repay it in part. I would like to hear from at least, this part was added that was never considered before, this particular sentence, the whole or in part. And I always envisioned that it would be paid back in whole, and I don't know how other towns do this or what the process is or whether people feel this is, we're not in a position to have people coming in and paying $50 a week against these deferrals if they want to pay them off. Because then what do you do with the liens and the filing and the administrative or whatever the case may be? That's my own personal feeling on that.
So, Mr. Simon, just so that there's clarity, and I don't be nitpicky about this, can you simply
Yes, I would
make
put
a motion for
yes,
specific language?
Yes, I would put a period after the word whole. At the end of number 4, the cumulative amount of deferred taxes plus interest may be repaid in whole with a period.
Is there a second to that? Mr. Kelly? Discussion on this one point, and we'll move on to other points, but just on this point. Ms. Tarkington?
Well, I do agree with Mr. Simon. It would be a burden for the town to obviously get small payments. But, if someone perhaps had deferred 10 years or 3 years and was repaying 2 of the years, I mean, there might be some amount that wouldn't necessarily be a burden, but would reduce the amount of the lien against the property. That's just a comment on it. I mean, I can live with the in whole, but I do think in terms of our residents, they might want to prepay some of it. But I definitely agree that there should be no burden on the town, and just because sometimes it takes a while for things to get someplace, that's why I put the 5 days, but I don't think that's needed either. Thank you.
Mr. Finger?
I would ask that Mr. Simon consider amending or restating his motion so that the period not appear after the word whole, but it read, the cumulative amount of deferred taxes plus interest may be repaid in whole at any time. I think by putting just a period at the end of whole doesn't really do much. The intent was that it be paid at any time. I think that was Leslie's intent.
Mr. Kelly, a sense? Ms. Spartan?
I have an alternative suggestion, which is if the concern is the burden on the town in administering partial payments, that rather than make it at any time, we make it at the annual period, July 31st, or July 1st, when the lien is placed. That would be a time when someone could come in and pay as little as $50, and the lien has to be refiled anyway. It could be refiled once a year, and just not allow people to come in any old day of the week and pay off whatever they want. That would be an alternative way that would address the town burden without imposing a penalty, so to speak, on the taxpayer.
Okay, so you've heard an alternative by Ms. Barton. Guide yourself accordingly in relative to this motion, unless Mr. Kelly and Mr. Simon wishes to make or withdraw their motion. Then what we will do is we'll listen for further discussion on this point, knowing that if this fails, Ms. Barton will be offering the alternative language.
I don't feel strongly about it.
Any further discussion on Mr. Simon and Mr. Kelly's motion?
Is it possible to hear from the commission or the town administrator or the assessor?
The question was, can we hear from either the town administrator, the town assessor, or the comptroller regarding? My understanding it's through the tax collector's office that this would be the.
There's no representative here, I don't think. So there's not much I can say
Okay.
other than.
Fair enough, thank you.
We should definitely cut that guy's.
What about Ms.? You don't care one way or the other?
Mr. Crumick.
This is just a comment about the deferral program in general.
No.
Is that in order?
Let's wait. Let's just
Just let me know when I'm in order.
I
and
will.
I'll
I
make
will.
my comment.
You'll be the first person to call upon when we get to that point.
Thank you.
Okay. Any further discussion on this point? All those in favor of the Simon Kelly motion signify by saying aye. Opposed? Abstentions? 10-0-1. Okay. Ms. Barton abstained.
And I withdraw my suggestion in light of the vote.
Okay. Mr. Simon, I'm going to stay with you in case, unless you have other suggestions.
No, I'm all done. Well, do we want to vote on the trust?
No, we agreed that that was part of the document that we're voting on.
I'm done.
Are there any other comments, questions, or specific motions to make to the document that's before you? There are two, and then I'll get to Mr. Crumick's overall observations. First, I want to certainly Channel 79's taping of the Budget Committee must be working and working well. I received correspondence regarding my question pertaining to residency requirement, and Mr. McLaughlin, thank you for your office's response to that. But as an education to the public, just so that everybody knows, because we didn't talk about it here, it was indicated that, in fact, there cannot be a residency requirement greater than the one we currently have in place, which is anywhere from a year to a year and a half, depending on how you look at this. And therefore, to not be in violation of the law, we are going to maintain this statute this ordinance as it is, without such a requirement. And I had received a number of comments suggesting that they would agree or had agreed with my comments regarding the residency, and that's why we're not adding that residency requirement in there. I am confident that that issue will again come up to the RTM, and therefore all your hard work will pay dividends not only before us but before the RTM. In addition, I think I'd like to highlight Ms. Barton's points made at the Budget Committee, and that is that this body, in approving this plan, is doing so, and granted there are various procedural matters that we need to go through in terms of funding this, but clearly I think we always talk about lessons learned. I think the BET should take note of that from last year's conversations, and that we as a body in approving this should be committed, and it's expected that this program, along with the tax credit program, will be requested for being fully funded, and that we should not jump lightly into this pool, that if we're going into it, we should at least have an understanding going forward that it's the intent to fund this program. What that means, I think, has yet to be seen based on what it is, that number of people that come forward. It's not expected to be a large number of population, but we have to be prepared for that and those consequences. So I echo those comments in the spirit of this document. With that, Mr. Crumick.
Yeah, I just wanted to comment about the deferral program and about the tax credit program. As many of you know, I believe that it's very important for us to give tax relief to seniors in our community that have lived in their house in many cases for many, many years, and who have seen the value of their house and their taxes go up over the years. And we did a good thing a number of years ago. We started a tax credit program for the seniors. We're going to do a good thing today, and we're going to establish a tax deferral program for the seniors. And what that means is that seniors who qualify because of their age, and by seniors, of course, I'm referring to old people, not people in the 12th grade. Although my daughter, who is a high school senior, probably would like that relief program. But it's important, I think, to look at the two programs separately. Now, I understand why we have combined them in this proposal, because deferral is a new thing, and new things sometimes are regarded somewhat askance by Greenwich. And the tax credit program was a new thing a few years ago. I think it's turned out to be a very valuable tax relief for qualified seniors. I would hope that in the future, when we get more comfortable with tax deferral program, that we separate the two, because they really are different programs. They shouldn't be combined in a single cap. I think we're going to find the tax deferral program, the town is very well secured and will collect the deferred taxes. We don't know when, but I think as the program goes, we're going to be assured of collection, and people will become more comfortable and separate the tax credit and tax deferral programs on the cap so that more money can be used for tax credits. And so that if we find that the tax deferral program is popular, then that can go on its own as well. But I do think that we have to remember that we are not as generous as other communities, notably Westport, and that we are a wealthy town, and we have seniors in our community that need this tax relief and frankly deserve this tax relief. So I will vote in favor of this, recognizing that it is just the first step in a program that I hope will be very successful for the town and for the town seniors.
Further comment? Is there a motion to approve this? Oh, Ms. Barton.
I have a question of the tax assessor. The operating plan that we'll be considering later this evening reflects in a risk for these two programs the fact that the number of new applicants will probably increase by 2 times, or from 600 to 1,200 applicants. If that happens, what happens to the economics that are underlying our approval of this program and our belief that it will fit within the cap?
We did a spreadsheet which was distributed to you where we projected how many people could fall into this program, and I believe the number was 254, if my memory is right.
More or less.
That would fit within the cap.
But that's a far cry from an increase from 600 to 1,200. If the size of the two programs together doubles next year, what does that tell us about the projections that we're basing our approval on tonight? Are we going to hit the cap?
We're already looking at it at the number of about 800 people being the number receiving the benefits. So we're looking at an additional amount. And I think we were asked to figure out what the maximum could be, and we did that. So I think that unless things go, very, very broad, this becomes very popular, that we would fit within the cap as long as it just didn't become what everyone wanted.
Ms. Barton.
My concern about this always has been, and the members of the committee who are here tonight will remember that I've said this before, is that we're a little bit schizophrenic about this program. It is being presented for approval on the theory that not that many people are really going to like it or want it. And yet it was designed, and I participated in the design of the ordinance that you just heard us discuss. It was designed to be attractive, more attractive than the credit program, and also more expensive than the credit program. So that's the concern. We've run a lot of numbers, and I did see the spreadsheet, Ted, that you allude to that shows that we could go up to 258 or something applicants without exceeding our cap. But Westport has far more than that, with a much lower population than Greenwich. So while I support senior tax relief, and don't get me wrong on this, I'm prepared to vote for this plan, I remain concerned about the cost, and it is why I've mentioned, as Mr. Walko mentioned earlier, at every opportunity, that if we're going into this, people, including the residents of the town and the RTM, not just this board, need to be prepared for the fact that the program could be expensive. Right now, it has a cap of more or less $1.3 to $1.5 million. But if we end up with applicants coming in with applications of $1.6, $1.7 million, are we going to go back to the drawing board and increase that cap? Or are we going to freeze out people who are at the higher income levels, or what? I think those are very serious questions that we all need to take into account as we move forward. As I said, having said that, I'm prepared to support the program. And I, for one, hope it's a great success and that next year we're here talking about how big the program should be as opposed to how little people seem to like it.
Further discussion? Is there a motion to approve the senior tax deferral ordinance as presented? Moved by Mr. Simon. Second by Mr. Kelly, the town assessor. Mr. Gordon,
I wanted to speak to one point, if I can.
please.
One of the amendments that had been made or suggested was to change the effective date of the application to the second Monday in May. And I would suggest that you reconsider that as an amendment for several reasons. The first reason is that the credit program that the state has May 15th, and everyone in the state is used to May 15th as the date of applying for the senior tax credits and for the deferral programs that are in existence. And to change it to an earlier date, I think would present some confusion in the public's mind. I think that part of the reason for this was on the basis of having a better idea about what the mill rate would have to be. However, I'm going to suggest that that the impact that it will have on the mill rate will probably not be that large, because the mill rate is based upon a grand list that is very, very large. And if we were off on the program by several thousands of dollars, it would not have a major impact. The other thing is we've always given you an estimate in past years, and our estimate has been very close to the reality. We'd like to continue doing that because, first, in order to actually calculate what a person is going to get, we have to know what they're getting on the state program, because the total tax that gets deferred or credited cannot exceed 75% of the total. And we won't know what the 75% of the total is until after May 15th. Second, the state provides for a 30-day extension so that the elderly that are not able to get their documents together on time can be given a 30-day extension. Also, we find that each year, in the last week before the 15th of May, there is a large number of people that come in that have simply put it off to the last minute. Last year, it was about 40 people. And if this year we changed it to an earlier day, such as May 7th, as opposed to May 15th, I really fear that there could be 30 or 40 people that didn't understand the change that would have to be taken out of the program because they did not apply in time. So I'm very much recommending that you stay with the May 15th deadline as opposed to trying to seek a week earlier in the month. I think that the estimate that you get is sufficient that you can make a good judgment about what the mill rate should be or has to be. And I think that the confusion to the taxpayers would be just too much to bear in terms of picking up or saving 1 week, getting them to come in 1 week earlier.
Is there any discussion on that point? Mr. Simon, Mr. Crumick, Mr. Tarkington?
Well, I added the second Monday in May, thinking it would make it administratively easier for when we had our BET meeting to decide on the third Monday in May what the amount was. I had a discussion with Ted, and it was my fault for not proposing to delete those three references and reinstate the May 15th, and I would support his suggested amendment, because I think from all the reasons he gave, it makes more sense to go back to May 15th than what I had proposed.
Mr. Crumick?
I think that the people who are the movers and the seconders could adopt that amendment.
Well, I would simply ask, unless there's an objection, can we adopt that by unanimous consent?
Yes.
Okay, so we'll adopt that any change referencing the second Wednesday in May revert back to Monday in May, revert back to May 15th.
It looks like it's in paragraph 9 on page 4.
It is.
With that unanimous consent, it's motion by Mr. Simon, second by Mr. Kelly. All those in favor?
Aye.
Opposed? Abstention? 11-0-0. The second item under old business now comes before us, the approval of the revaluation 2010. For that, our town assessor again, Ted Courtney, who's here with the assistant town assessor, Bob Shipman. Good evening.
I recommend that the town proceed with the revaluation for October 1st, 2010. In my report, I gave you 4 reasons which I think are important, and if I could just summarize those. I think that it is time to bring equity in the community. We have done the sales studies, and we do know that there are differences within the community from one part of the town to another part. And we know that in fairness to all taxpayers, it should be done this coming year. 2, we now have sufficient number of valid sales to proceed with the revaluation, and the sales are starting now to increase in numbers. And we're getting back to where we had been in prior years. So we are expecting that the sales will continue throughout this coming year, and that the information will be there for us to do modeling that will be sound modeling and to come up with the proper values for this coming year. Third, if we delay or drop the revaluation, the contract, I believe, would have to be rebid for the simple reason that the contract has a final date on it that it has to be completed by, and we would be having to then get out of the contract that we're currently in. The problem with that is that a large number of other communities have deferred their revaluations until 2011, who would have done it in 2010, which is going to mean that there will be more difficulty in rebidding a contract, finding a contractor who's going to be able to do it. Certainly, the prices of doing the work will probably be higher. Second, they'll probably have staff that is not as experienced as the staff that we're able to get for this immediately coming year. And we think that we do have a contract in place and that we should stay with that contract. And then fourth, I mentioned that we deal with the public every day. And there is a perception that there has been some declines in sales prices, and that thus far we've not reflected these changes in selling prices. And I think that the public wants to have us reflect these values, and they're expecting to see the revaluation done in 2010. So those are my basic recommendations. I'd be glad to answer any questions that you have.
Mr. Mason.
Couple series of questions. They've changed the statute, so we could postpone this till 2011, correct?
Yes.
If some of us in discussions, including myself, are a little leery about doing this because do we have enough information? But I guess my question is, what would be the cutoff date where we could say tonight, okay, let's proceed on with the evaluation for 2010, but what would be our cutoff date to change our decision and say that there's just not enough information, or we're not happy with the information? Can we go to 11? What would that date be?
Well, first, in order to get the work done, we're going to have to proceed with the market modeling and the review process. So we need to get that going right away. If we went ahead several months, we would have to do double data entry. We'd have to do data entry on continuing with the old assessment roll that we have now, as well as data entry on a new grand list that would reflect the revaluation numbers. So there would be some additional cost involved there and additional time. And our staff, I think, as you know, is not as large as it used to be, and they're having a hard time keeping up with things at this point. So I think that if you made a delay, it should be as short as possible. It will impact us if it gets delayed, much more than January or February, for example, at the latest, because after that we just have, like 6 to 8 months to complete everything, and it would be virtually impossible to do it.
So what you're saying is February may work? If we decided to take that second look in February?
As long as we can get going tomorrow on doing the revaluation, doing the modeling, and getting all the basic work started. If you wanted to stop it, you could stop it to a point not later than the end of February.
Okay. Then if we did that, let's just say we did that, what do you anticipate the cost could be to your contract that you have in place if you rolled it into an 11 reevaluation?
I think we'd have to get a new contract.
Any idea what the cost could be on that?
No. I'm sure it would be higher, but I don't know how much higher.
Thank you. Mr. Stone?
Ted, you present a very compelling argument, series of points here, but I'm sure you agree that an ultimate concern that we should have in mind is the greatest accuracy possible. We're dealing with a subjective area, and you make the point about the statistic validity of the number of sales recently, the 360 in the past year. Just out of curiosity, what was that comparable number of sales during the year on which you based the current revaluation?
Well, I gave you a spreadsheet that looked at the last 4 years, and you can see that the year following the last revaluation, there were 988 sales. And the year preceding that year, there was approximately the same number of sales.
So some 3 times the size, more or less, of what we've recently been seeing. I guess there's a concern I have to a degree, and that is that we might be, for certainly valid reasons, trying to accomplish a revaluation as quickly as possible, but we're going to be using this number town-wide for the next 4 or 5 years. And I'm wondering, do you feel confident that the number of sales that you're going to be basing it on will give you an accurate picture of what the, let's call it, what the sales and valuations are town-wide?
I spoke to the modeler that we've used on this project, internationally famous modeler, and he's saying that other jurisdictions are facing exactly the same problem that we're having. And what they've been successfully doing is doing time trending analysis going back 4 years. They're able to actually study and see what has happened in the market, and they're able to plot it very finely right to the current market status. So we're not looking at a total of 360 sales. We're really looking at the grand total of sales, over 2,000, that have happened over the period of time. In addition to that, in addition to the sales that we have here at this point, we have the next year of sales, and we can make adjustments right up until October 1st of the revaluation year next year. And if we did see that the predictions that we made had a downward trend or an upward trend, we'd be able to make those adjustments at the last minute. In addition to that, we also have now a very good history with the multiple listing service. We're able to track what's happening there, and we can almost predict what the listing prices are going to sell for. They're selling now for a very tight fit with what they're listed for, a certain percentage below that. So we have much more evidence than these 360 sales that we're talking about here. We have all the past sales that we can trend, we have the future listings, and we have the future sales. And I'm confident that with all of the information we have available, we can do as good of a job as we did on the last revaluation. In fact, I think we can do a better job. I think we can use better methods, better methodology, and do a very credible job.
Okay, thank you.
Mr. Campbell, and then Mr. Campbell.
Mr. Guardi, I'm inclined to defer to your judgment on this, but I did, maybe if you could answer this question in a way that the general public, of which I consider myself a member on this, could understand, because you refer, and I'm sure it is important to your modeling, to several years of data, but to most of us, what we know is that everything changed last fall, and the market froze, and we're struggling to understand what relevance sales numbers over the preceding years would have when we seem to have had quite a drop in asset values, and specifically in real property assets, during that time from September of last year, maybe through to the present day. I don't know about the trends the last several months. And then if I could, I'm giving you a long question, but looking at your data, you know, you refer to 360 sales in the past year, but of course several of those months, I would guess, saw an ever declining market and fewer sales, so that it would seem again to a layman that it's the last several months only that seem to reflect enough sales that we could say, okay, now maybe we have a better idea of where market value is. I don't know if that amounts to a question that you can answer, but
we are able to look at past sales. We're able to look at all the sales that are on this record here, and we're able to show the trends of what the prices were when they sold back in 2006, 7, and 8. And we're able to show trends of what those same houses would sell for today. And this is something you can track very, very well through a statistical process. We use multiple regression analysis, and we use sales trending type analysis. And we're able then to predict the future value of what houses should sell for. And we use this as a tracking mechanism so that as the sales occur in the future, we're able to prove that the values that we're estimating are in fact on base. And if we found that there were other adjustments that needed to be made through the summer of next year because of additional market trends, either downward, upward, or flat, stabling, whatever it is, we could make those adjustments before the grand list is finalized and approved. So I think that even if we wait, we're not going to be better off than doing it now. And I think it's better to do it now with the best information we have and to do the job that needs to be done and what the public is expecting. So I'm really recommending that we go with all the data that we have, and we don't wait for what might happen next year, and then ask, well, what do we do now?
So if I could just follow up, so it would be safe to say then that when you look at all this data, the last several months of sales are showing a decline in property values from, let's say, a year or a year and a half ago. Would that be an accurate statement?
Yes, the trend for the last year has been a downward trend.
And you feel then that particularly the last several months when there's been a rebound in the number of transactions that you show here, that's enough of a base for you to have confidence as you apply your model, those last several months?
Yes, it is.
Okay.
And I'm looking not only at the last several months, but I'm looking at the next 8 to 10 months that occur next year. And I do think that we're going to be reaching a point where we'll be able to predict selling prices quite accurately. And I think this is what other jurisdictions are finding. This has been done in a number of other states, and it's been done in other Connecticut cities, and they're finding that they are able to predict the values with a lot of precision.
Yes, Mr. Gwartney, like you, I too have had many people contact me about concern about the value of their home and the property taxes that they pay. Do you think that there's also an education process here, or are you educating these taxpayers that, with a reval, their value may decline and hence their mill rate is likely to increase, even though it's a zero-sum game? Some of our residents may not understand that, although I believe we all on the board and you do. What is the best way of helping all of us educate the residents about the shift that we're going to see? At least in my time that I've lived in Greenwich all these decades, I don't remember with a reval the values declining and the mill rate actually increasing. It's generally been the opposite.
I completely agree with what you're saying. I think it is going to be very important to educate the public. I think the public already has a perception of what is happening. I think that most people do realize that there has been a downward trend in value, and people that come into our counter oftentimes also are appreciative of the fact that if the entire grand list is going to be dropping, there has to be some change in the mill rate, and that the taxes, even to be equal to what they were this year, might result in a higher tax rate. I know that I've written a couple of letters that I've sent out to people that are asked this very question that very clearly explains what might happen, and I'm using that now routinely when I get questions of this type coming in from the public. But I think it's going to be up to not only my staff, but I think the members of the Board of Estimate and Taxation and other public officials to start really educating the public on what trends there are and what this means in terms of future revenue for the town. We're not going to see the revenue of the town go down. We're simply going to see property values changing and mill rates changing in accordance.
Ms. Tarkington?
Just asking another question or two here. In the past, there's always been an important regression analysis model behind this related to the land model for the residential properties. And, I think as of the last revaluation, residential land was valued at something over 70%. It's a percent of the total. When you talk about this, is this going to be a more difficult issue this time to look at the land, since there are so few, at least in the data that you've shared with us so far, land sales and tear down land sales? How are you going to develop the model to better or to revalue the land? Because that's been significant.
I think to answer your question, we are going to be seeing land values declining in the town. Probably much or most of the decline will be in land values instead of building values, because this is kind of where the surplus is. I think that you have to realize that we not only have several hundred vacant land sales and tear down sales, but in addition to that, every other sale that we have has the ability to do a land residual analysis. The land residual analysis means that we have perhaps the same 2,500 land sales that we can use to do a good job of estimating the land. And these can be checked against the other factors of knowledge that we have about land.
Mr. Simon?
Yeah. I think I'll just go back and answer Mr. Mason's question, I think. I don't anticipate if we vote tonight to do the revaluation for 2010, we would vote to stop it in the middle of the process. But I think it's important that, this board still has to accept the revaluation. The revaluation has to be done to certain professional standards, and we have to look at those standards and agree that we have done a revaluation that meets the standards. To actually answer maybe Mr. Campbell's question, you need to develop a statistical model that accurately predicts the sale price of previous sold houses that were not used in the model to fit the data. And if you can do that to a certain standard, then you have a model that has enough validity to go forward and apply it to the entire population of homes that didn't sell. And when next fall, when we look at the results of the model, this board will decide whether or not the work you've done meets the professional standards as set aside by your profession in the state of Connecticut. You will present the statistical evidence we need, and we will make a decision at that time whether that you have enough data to accept the work you've done. If not, we could defer it till 2011. We're not committing ourselves to accepting the revaluation, but we're giving you the authority really to go ahead. If we vote tonight, we're giving you the authority to go ahead and proceed. And there's two different steps here.
Yes, thank you. In essence, what Mr. Simon is saying is that you really have up until October 1st of next year to make the decision, and we will do the best job possible to prove to you that we have done a good job in doing the modeling, shown you the results against sales that are currently happening, and proving to you that we can meet within the standards of having a standard deviation that would be acceptable in the assessing profession. And I think at that point, you then would accept the revaluation and move forward with our sending out the notices and using the roll for the 2010 grand list.
Further questions or comments? Is there a motion to approve the revaluation for 2010? Moved by Mr. Simon, second by Ms. Tarkington. Further discussion? All those in favor signify by saying aye. Aye. Opposed? Abstentions? 11-0-0. Mr. Gwartney, thank you very much. Obviously, I know it's in your assessor's report every month, but obviously now that we committed to going forward, please ensure that the update for the reval is moving along, and any time that there does become an issue, make sure that this body knows about it. I also anticipate in the next term, starting in January, that a special project team, again, will be, whether it's reconstituted or continuing on with the same members, to assist you, to be a sounding board for you, and ask members of this board that if there are questions, that they go through that special project team. So thank you again. Mr. Gartney, we'll just have you go first on this. Under new business, our first item, item 10, is the approval of the assessor's operational plan as well as the 10-11 budget. All of you obviously are aware that we approve as a appointing authority the operational plan and budgets for both the assessor's office and the finance departments. Tonight is our night to approve them. Obviously, we will also be reviewing them through the budget process, and they'll be submitted to the first selectman for a consolidated budget. But at this point, this is our first look at their budgets and operations plan. And so why don't we take up the assessor's budget and operational plans first. I'll just combine them, if that's okay with everyone, and ask for a motion to approve them. And if we have comment, we'll take it after that. So is there a motion to approve the 2010-11 budget and operational plan for the assessor's office?
I'll move it.
Moved by Ms. Tarkington. Second by Mr. Simon. Discussion. Mr. Simon.
I think the assessor's budget really only goes up to $277,000 for the revaluation. It goes up probably by the contractual increases for salaries, which is only the whole budget only goes up by $15,000, or about 1.5%. I think it's a very responsible budget, and I recommend we vote for that. In terms of the operational plan, I think I've read these plans for 3 years. I think this one is one of the better plans, although it could use some tweaking as we go along. I think he did a very nice job, and I think we should also approve that and work with him during the year to maybe fine-tune it. But I would recommend both of these be approved.
Further discussion. Mr. Kelly.
Can you tell me what a coefficient of dispersion is? And is 12% good? Is there a benchmark?
No, that is the benchmark.
I'm on goals, 5A, performance measures. Achieve a residential coefficient of dispersion under 12%.
12% is what is kind of the assessor's standard internationally. If you cannot get on single-family residential property into a 12% coefficient of dispersion, it shows that your model is not as strong as it should be.
All right, so now we know it's a benchmark. That's good.
Yes.
Now what is it?
It's a measurement of how sales disperse from their assessed.
You're not allowed to use the
value.
same word in a definition.
We measure the selling price against the predicted market value of the assessment.
Okay, so that's what you're doing.
Yes,
All right, and that's how you measure it.
yes.
Okay, all right, thanks. I have some other comments when you finish with everybody else.
I think we're at that point.
Okay. Can you tell me, back to page 5B on goals, Mr. Gortney, one of your goals is to meet with the town attorney and taxpayer representatives to dispose of some of the cases. Do you meet with the town attorney on a regular basis with respect to the litigation?
Yes, I speak to the town attorney almost on a daily basis, and we are trying to resolve cases. We are subject to, of course, to the court systems, and they're the ones who schedule the court cases.
No, I don't mean a long answer, just a short one. So you meet with the town attorney regularly on the litigation that's involved in the assessor's office?
Yes.
Okay, that's what I wanted to know.
It's been moved by Ms. Tarkington, second by Mr. Simon. All those in favor of the 2010-11 budget and operational plans for the assessor's office, please signify by saying aye. Aye. Opposed? Abstentions? 11-0-0. Okay, Mr. Gortney, I now do believe that your work is done here tonight. Thank you. Before us now is the operational plans and budget for the Finance Department. I've had a chance to review the operational plan of the Finance Department, and the budgets are submitted also for your approval. Is there a motion to approve? Moved by Mr. Norton, second by Mr. Finger. Everyone is very quiet tonight. I'm not sure if it's my hearing or if everyone's just...
No, it's because I'm back.
Oh.
I thought it was the Boy Scouts myself. They were a good influence.
I'm not sure how to read into that, but so I won't. Other discussions? Is there, all those in favor of the Finance Department's operational plans and budget signify by saying aye.
Aye.
Opposed? Abstentions? 11-0-0. Okay. Now we'll go into multimedia. Hopefully it'll reinvigorate everybody. The last item to come before us this evening, item what is essentially 10B, is the Town of Greenwich bonding presentation. Peter Mynarski, our comptroller, I'll turn it over to you. You should have received a PowerPoint presentation in your packet, as well as some additional information regarding how specifically relating to the Town of Greenwich.
Okay. Roland Geiger is going to set up the PowerPoint presentation. In the meantime, I'll go over the three parts to the presentation. I have Mark Chapman from the Independent Bond and Investment Consultant firm, the financial advisor. Hereafter, we reference them as IBIC. They're going to go through part one, which is 19 slides. Part one is an overview of bonding for municipal governments. It's generalization of terms, the process, and I would request that you wait for all 19 slides to take place. We'll stop and we'll answer questions, and you just simply, Mark will be given the presentation, reference the page number, which will be the slide number, and then we can go back. Part two, you have a handout, which is the status, it's the snapshot of the bonding program as it stands right now, and I've enlarged the presentation, and that'll be from your desk to me at the dais here, and I'll walk you through the process, how we go bands, bonds, and how it tiers itself, and answer any questions as we go along. And then part three, we'll go back to the last three slides, which is benchmarking, and it shows where we are now and how that projects out into the future. So,
Before we begin, I just want to make sure the oversized sheet that was presented to us here tonight is identical to the sheet that was contained in our packet?
yes.
Okay, just enlarged.
Just for the presentation, if you can't see the screen, I have handouts. Does anybody need a handout to follow the presentation? They'll be up here if you do.
I'm hoping that Channel 79 and the Wizard is able to pick this up, because I think this is an important discussion. We talked before about educating the public, and I think it's critical. A lot of times, especially the RTM, asks us questions about our bonding models and where we're headed. So if on reviewing these minutes or this meeting, I would suggest that this might be an important part to pay attention to.
Okay, you want to stand in the back? Or this is.
I have a camera that's right on, so if you do any damage, just keep the slide a little bit so that I can get the PowerPoint.
I need to stand close to the computer so I can.
Roland's going to do the computer.
Well, just again, don't stand right in front of the screen.
Oh, okay.
So, if you're not standing in front of the screen at all, that's fine.
Okay. This is Mark Chapman from IBIC.
Okay. I'm just trying to not have my back to anybody, and I apologize for that initially. Once again, I'm Mark Chapman, partner at IBIC, based out of Madison, Connecticut. We represent almost 40 municipalities in the state, and we only work with municipalities from the state of Connecticut, and we help them when they're coming to market to issue debt. From the beginning of the referendum or ordinance process all the way until the town receives the funds. The first question, pretty obvious question, why issue debt? Perfect world, and for a long time in the town, we didn't have to issue debt. But it gets to a point where when does it make sense to issue debt instead of using current resources? When the projects become too large, for instance, and you're looking at using and maintaining intergenerational equity. When you have an asset that is going to be outstanding for 40 years and it's going to be used by several, at least a generation or two, why have that first generation pay for it all is usually a good indication. And also when the current resources, quite frankly, are just too large to be paid for in cash, and you need to go ahead and issue debt for that. And also a local policy. For a long time, the local policy was not to issue debt in the town, obviously. And these slides were developed with the help of Peter, and also some questions that were brought on by the board. One of the questions is, what is the municipal market and how big is it? It's a very large and fluid market. It's as of October 2009, there was $2.8 trillion worth of outstanding debt. It's a very active secondary market. It trades very fluidly. Not a year ago, but for the most part, it's very fluid. The types of investors: money market funds, mutual funds, insurance companies, and banks. On the retail part, individuals and banks, bank trust departments. Retail investors are a major participant, either through the funds or direct holdings. And that's really, I would say over the last 5 years or so, is really what's been driving the market and keeping it sustainable. And part of this is the perception of low default rates. And it's not necessarily a perception. Historically, looking back, the default rates are virtually nothing for municipal debt. What is the makeup of the $2.8 trillion of municipal market, and who are the holders of that? A vast majority of that, as you can see, are households or individuals, and the other largest piece are in the mutual funds. But it just kind of gives you an idea of who's looking at this and why are they looking into the investments. To get a little bit more specific in what's going on year to date, there's been over $300 billion of bonds issued, municipal bonds issued year to date. Of those, a vast majority of that has been, I'll back up, from cities and towns, and I think direct issuers was a checkbox in the questionnaire for these folks. But cities and towns and direct issuers make up for about 13% of the market. So we would fall into that 13%. And for what purposes? Basically, the largest pieces are general purpose and education. Kind of makes sense just from a general standpoint. This fun chart here wasn't meant to confuse us. I was just kind of trying to give you a historical perspective of where we are in the market, and trying to give us some benchmarks and give you a perspective where we are today versus whatever time period going back 20 years. Obviously everyone's familiar with the 10-year Treasury. We kind of follow that on a day-to-day basis. It kind of used to give us an idea of where the municipal market was going. And we obviously know what the Fed funds rate was versus what it is. And the bond buyer 11, that's an index that we use in the municipal market that gives us an average yield at the 20-year yield, and where interest rates are. For the bond buyer 11 is 11 municipalities with a AA1 average credit rating. I'll get into credit ratings. You're obviously AAA, but AA1 is what this index is, and it's really the best indication and to give us an idea of where we are. But the purpose for this chart was we used to be able to follow the 10-year Treasury, and it would give us an indication on where municipal rates were going. About a year ago, January of 2008, they became decoupled, or they went in separate directions, and they really haven't come back. There's points in time over the last year and a half that they have worked in conjunction with each other, but really since January of 2008, they've kind of gone in separate directions, and so it makes it more difficult for all of us to figure out what rates are going to be in a year now or 2 years from now. We hope that they come back together at some point and would give us a little more guidance, but at this point, the investors and the investment community aren't being very cooperative. What types of financing vehicles can we use? What we're really talking about doing, my understanding, Peter, is the general obligation bonds, which is the full faith and credit of the town. They're not secured by a specific property, but the entire town. If the issuer or the town defaults on the obligation, on paying either the interest or principal or both, the bondholders have the right to come back and collect the money one shape, form, or another. One of them is to force the community to raise taxes to make sure they can pay their debt. The other avenue is what we call revenue bonds. It's not the full faith and credit of the community. It's a limited obligation. The bondholders have the first lien on typically a facility or an asset, and if the issuer defaults, they have the option to foreclose on the facility. And examples of that are water and sewer systems, utilities, or toll roads. And then how can we, in what way can we issue this debt? Connecticut, typically it's bonds and notes. Bonds in the municipal market are typically from a range of, I have one up there, it's usually 2 to 30 years. 30 years being the max, and that's per state statutes. Notes are typically, for municipal market, are less than 2 years. Or are less than 2 years, and typically in the state of Connecticut, we issue them for a year, but they could be shorter. They could be a month, 3 months, up to a year. And you can renew that. You can renew those notes up to 10 years after the initial issuance date. Used to be 7, I believe, and about a year ago, the state statutes changed to 10 years for that. When the decision is made to go ahead with the issuance, we have to decide on how to structure the debt. Sizing of it, which is typically subject to IRS regulations and spend down requirements. If you have a $40 or a $20 million project that's authorized and you think you'll end up doing it over the course of the next 5 years, the IRS doesn't like that we go ahead and issue the $20 million now with the hope that we'll spend it over the next 5 years. They have certain time frames that you need to spend 50%, 75%, 100% of that, so that they're not deemed arbitrage bonds, meaning borrowing at a low rate and not in this environment, but investing at a higher rate. Term, they typically match the useful life of the asset. My understanding, or local policy, and most of the that we're talking about is over a 5-year term in the town. Maturity and payment structures. Once again, we're limited per state statutes in what we can do. Really can't get too creative in what we're doing here in Connecticut, which is, I think, a good thing. What we are limited to do is the way we structure it. There's really 3 ways: level, principal, and interest, like your home mortgage. you can do level principal, or you can do a low to high structure in your principal. Really you can't have issue debt today and not have a payment for 20 years. It's something the state of Connecticut doesn't allow for it, and I think it's a nice practice that they put in place. Fixed versus variable interest rates. Those are what we have traditionally done in the state. Most of the local municipalities go with a fixed rate. It gives you the defined interest and principal payment that you have to make over the course of 5, 10, 15, or 20 years versus a variable rate. And usually the variable rate models are based on the volatility of cash flows. And they're typically, when you have a source of revenue that's not as stable as a tax base, like an income tax, for instance. And then redemption provisions, what that really is, if you're issuing a 20-year bond, you like to have a called feature in there. One, to help you with, in case interest rates come down in the future, you can refinance those as you would your home mortgage. Who are the players or participants in this whole transaction? Obviously the issuer or the town, financial advisor, which would be our role in here, bond counsel, who will help you with the local ordinances and also with putting their opinion on the authorization that these are in fact tax exempt, and that opinion will carry forward with those bonds for the life of them. The underwriter, who is the purchaser, investor, who will then buy them from the underwriter, and other participants. Once again, per state statute, we're required in the state of Connecticut to have a registrar or a paying agent that's a clearinghouse for your payments. Rating agencies, which we're currently using Moody's and Fitch, I believe, Peter, is that correct? And credit enhancer obviously is not a factor for the town. The borrowing process, and once again, I apologize if this was made very elementary. We kind of start with that, and then I'm sure we'll have some questions on all these things. We obviously identify the need in the capital plan, which I think you all have done. We then determine the sizing, the term, and structure of the financing. You obviously need to have the legislative approval, which is first through you, I believe, and then the RTM. We developed the prospectus, or the official statement. We obtained the bond ratings. Skip right over credit enhancement. We don't need that here. We then go to the market to sell the obligations. We close and receive the funds. Seems like a very simple process, but it takes a little bit of time. And how can we go about selling your bonds or notes? Competitive sale, negotiated, or private placement. Traditionally in Connecticut, vast majority of the new money issues are sold on a competitive basis, and we would recommend that as well. When you get into some of the more complicated issues, refundings, story bonds, if you're a lesser rated credit, then we would probably need to negotiate those with an underwriter. And private placements is when you have even a better story to tell, in which we don't have that here in town. The ratings, which is a pretty important part of this, they've lost a little bit of credibility, I would say, over the last year and a half or so. The municipal end really hasn't, but they're in that group, and they have the big umbrella, so they're part of it. What the rating process is, it's basically an assessment of the creditworthiness and likelihood of repayment, which is why the town has a AAA rating. The likelihood of non-repayment is extremely minuscule. Initial ratings are typically assigned just before their bonds are sold, and they're updated with each parity bond sale, which means every new sale. If the town or a town decides not to go to market and sometimes we hear, well, we won't go to market for another 10 years, so what do we care about our bond rating? They are obligated, the credit rating agencies, to come back and assess the community as long as their bonds are outstanding. They should be doing it every 18 to 24 months. Depends on the credit worthiness. The lesser credits, they're probably on them more versus the higher rated credits. But they do come back and they kind of have the obligation to their investors to make sure that the communities that they did rate initially maintain that credit worthiness. As we mentioned, there's 3 major rating agencies. Currently, the town uses Moody's and Fitch. The rating categories are AAA to C, C being the worst, AAA being the best. And there is further gradation in that. That go after AAA being the best, it goes to AA1 using Moody's scale, AA1, AA2, AA3, and then A1. We're pretty locked in at AAA here, so we'll be all right. As I mentioned, in general obligation bonds in the state of Connecticut, really can't get too creative. It's pretty as vanilla as it gets. And one of the things we wanted to point out, we like to point out to communities, because this changed in '96, is that the municipality is only allowed to borrow up to their local share. Meaning if you have an authorization for $40 million and you have estimated grants of $4 million, you can not borrow more than you can't bond more than $16 million. Basically, you don't want to borrow more than you need anyways. And locally, the authorization process is determined by Connecticut general statutes or by town charter and home rule charter towns. And for your town, both the BET and the RTM must approve it. One of the questions we get a lot, especially lately, is what is the state of Connecticut, how is that going to impact us locally? From a borrowing standpoint or a credit worthiness standpoint, virtually nothing. The credit and financial aspects of Greenwich, fortunately or unfortunately, from an analyst perspective, it's a good thing that the town doesn't really receive too much state grants. Obviously, from your point of view and from a former taxpayer in town, I wish we would receive more. But when it comes to these types of situations where the state is talking about, they just issued $1 billion of deficit notes, and eventually there's probably something will happen. It's nice that you're autonomous and you're not receiving that much in state grants. The market asset, they're very different credits, and the state does not guarantee your bonds. You are guaranteeing your own bonds, and the state is not behind your bonds at all. So they're two separate markets. And on a big scale, on macro market concerns, Connecticut really doesn't move the market. State of California does. New York State agencies kind of have some movement. They're really the big players, and they're the ones that kind of move things around. But the state, on the state level, does not. And our new favorite friend in the municipal market is the Build America bonds. This was part of the stimulus package in the American Recovery Reinvestment Act of '09, February of '09. I'll use the acronym ARRA. I think you've all heard of that. Build America bonds were set up to allow for issuers who typically issue tax-exempt debt to go ahead and issue them as taxable and receive a 35% subsidy. There's two ways of doing it. One, you can do it directly where the issuer receives the subsidy, or you can do it as a tax credit and the investors receive it. To date, not a single issue has been issued as a tax credit. They've all been issued as direct pay. There has been no limit on these. It's as much as the market will bear until the end of next calendar year. basically have the same restrictions as a tax-exempt bond. Everything that meets the tax-exempt bond criteria falls into the direct pay BAB issue. Excuse me, I'll use BABS. That's the acronym that's been dubbed. I apologize for that. And one key point, and the rating agencies have drawn up some drafts in regards to this. This is handled as a subsidy and not a federal guarantee. This is subject to annual appropriations, and highly doubtful that they would, 5 years from now, decide to not pay the issuers their 35%, but it is out there still that it could happen. I don't want to say never, but I doubt it would happen. Some other key points to this. Direct pay bonds were put in place per the stimulus, and they wanted to make sure that it was for current projects and not for projects that we have done work on 2 years ago. It has to be new money issuance. They expire the end of December of 2010 or January 1st of 11. There's been $52 billion of BABs issued year to date, with a wide range of issuers from the state of California to small issuers in North Dakota, from $2 million deal to $1 billion. Generally, what we've seen in the way the steepness of the tax-exempt curve versus the taxable curve, you're really getting your biggest bang for the buck when you get out longer in the yield curve. And with Greenwich's short amortization policy, it really reduces the economic benefit of this. We're not seeing the crossover in the yield curve not until we get out to year 6 through 10, and that changes almost on a daily basis, but it's usually further out in the yield curve. I'm sure there's no questions.
Great, thank you. Mr. Krummick.
I'm amazed myself that I'm asking a question about bonding. But this Build American Bonds, we have a couple of projects, large projects coming up. And I'm wondering if, and what I'm thinking of Nathaniel Witherell, I'm thinking of the high school performing arts project. I'm wondering if we looked at a couple of those projects differently than we normally have used, bonds in the past, the short-term bonds, to see whether they would be appropriate candidates for this Build America bonds with a longer amortization period. And I'm just throwing that out there. It may be that that this is an opportunity to kind of move up and get financing for some big projects that are already moving along pretty nicely in the planning.
Okay, I'm going to try to answer this question by talking with Mark. The nursing home, the plan, they have this long-range business plan, and in order for the model to work, they don't intend to bond until January of 12. You said that there's a window as far as for the BABs, and they would have to borrow within the next 14 months, correct?
Correct, the end of next calendar year.
So in the case of the nursing home, they wouldn't be a candidate as far as the borrowing.
Correct. And not to get into bond counsel realm, which I don't pretend to be a bond counsel, some have opined that it also needs to be spent by the end of next year. So that the projects have to be current, not bonding the end of next year and then spending it a year or two later.
So the two projects you mentioned wouldn't be candidates?
Because they wouldn't be spent within a year.
The next year, yes.
But we have other projects that could.
They wouldn't qualify again through Mark because they're going to be amortized over 5 years, which also would they wouldn't be beneficial to the town.
From a economic benefit, if you're within, depending on the time, but 5 to 10 years with the AAA rated community, you're really not seeing we haven't been seeing an economic benefit to issue the taxable BABs because of the steepness of the yield curve.
Well, the only, and again,
we are monitoring it though.
But I'm just thinking like the central, the fire station project. Maybe that would be a project that would be worthwhile putting under this program. And if we did put it under this program, you'd have to change to get the benefit of the program, you'd have to lengthen the amortization period. But I wonder if it makes sense.
They have been. I've gone through IBC since these come on the market about 6 months ago, I believe it was. They are monitoring Greenwich as far as being a candidate, and right now there hasn't anything that's come along that would put us into that arena as far as going with the Build America bonds. There is not. We are monitoring it to see which of these projects would qualify, and to date we haven't seen any that would be beneficial for the town to go down that road.
But I take it, hold on, I think that means under the current policy of 5 years, correct?
Yes.
Correct.
Right, so if Mr., hold on, excuse me. So if Mr. Crumick were to, or someone else on this body were to suggest that be extended, then it would change your viewpoint, presumably.
Yes, we would then review it and say, okay, 20 years, it might or might not.
What I'm suggesting is that we should consider being proactive, and if we can, and it's worth our while, if we can take a project that we know we're going to do within the next couple of years, and we can, and it's worth our while in the analysis to take advantage of this program, it may very well be that with respect to that particular project, we decide to fit it into the optimum for under this project rather than do it as part of our normal bonding process. But it takes analysis to do that.
Still questions for Mark pertaining to the slides that we've already been presented, not necessarily the other information that we're getting to.
Right.
Mr. Stone?
Just to further this point, Ed, I think you're looking at this Build America bond as somewhat of a free lunch. It is not. That 35% credit, and Mark, please correct me, is designed to try to equate a taxable with a non-taxable security.
Exactly. Yeah.
And we clearly have the ability, should we choose, and that's important, to issue a significant number of tax-free obligations. So we don't have to go this route.
Correct. And because of how, and this is dynamic, it's not what I say today is going to be holding true for a year, but currently the way the yield curve is, you really, unless you went out to 20, 30 years, you would not have an economic benefit for that. And you probably wouldn't realize it, or today, as the numbers showed me today, you wouldn't see an economic benefit until year 6. So if you had a 20-year bond and you laid out the two together, you had a tax-exempt 20-year bond and a taxable BAB together, you wouldn't see the crossover or reduced debt service payment until year 6. Right. And then you would have a lesser debt service payment, and then it crosses over again. But so the first 5 years, your debt payment would actually be higher. That, if you're following me on with that.
Mr. Kelly and then Mr. Norton.
My understanding for the BABs was just it enlarges the pool of possible investors in the bonds because people like CalPERS, I guess, who invest in, wouldn't invest in our non-taxable bonds, correct?
That's correct.
So, and we don't have any problem with subscription to our bonds.
No problem whatsoever.
So, all right. That was my understanding.
The BABs have helped the municipal tax-exempt market significantly. It's helped keep the rates on the tax-exempt lower. Otherwise, all these BABs that have been issued would be all issued as tax-exempt, and would kind of, the market would be diluted.
So, as we stand now, it's not really a benefit to us, the BABs.
Not today, but we are continuing to monitor it so that if that changes, that picture changes, then we would obviously recommend that.
Okay.
Mr. Norton?
Yeah, I have Both a question and a follow-up on page 6 on your chart on the BBIs. What is the maturity of those?
20 years.
That's what I thought. Okay. It's also my understanding on the BABs that the higher your rating, bond rating is, it works inversely to that. So that with the AAA bond rating, the benefit decreases, and most of the benefit is for the lower rated instruments.
That's absolutely correct.
So with the AAA bond rating, the benefit is less than if we were a single A.
That's correct. What the taxable rate is doing is eating into that credit spread.
Yeah.
That's correct.
Yeah.
Mr. Finger, did you have a question?
My question's been answered.
To my right? Okay, I think those are the questions so far. Let's go to phase 2 of the presentation then.
I'm going to work off of the larger sheet. The larger sheet makes it clear, especially when you get into the $72 million band issue. Before you, you've got a snapshot of the Town of Greenwich bonding program as of Friday, November 13th. I'm going to start, if you go to the upper left and you see the year 2627, First Selectman Jim Lash inserted a $2.5 million authorization into a $11,385,000 bond issue to both purchase a piece of land and to start the bond program officially. This was done in May of 2007. I put that there for illustrative purposes to show you this is where the actual bond program started. If you drop down to 2007-8, I'm going to start with column 1, and this is very important. If you could understand how this flows through this year, you're going to understand the whole the process of going bands, bonds, and tiering it. You can see the subtotals for each section. The general fund, the $24,124,000. Nathaniel Witherall, $7,003,000. Glenville School, $22,007,000. And then the sewer improvements, $2,130,000. Each one of them is backed up with a bond resolution, which Nancy Barton worked on through the law committee, and Robinson and Cole, and they are in the 2007 and 8 budget book. So each one of these gives us the authority to spend up to that amount for each one of these projects, and gives me, as the controller for the town of Greenwich, the authority to bond up to them amounts. I cannot exceed it. One exception is Glenville School, which was covered in Mark Chapman's presentation. He gave the example. You see where the $22 million, again, this is all column 1, $22,700,000. We get reimbursed from the state of Connecticut school construction reimbursements. We get up to 20% of eligible cost. So for every dollar we get in, you have to reduce that number. I can't borrow $22,700. I can borrow $22,700 less what we get in from school construction. Glenville School is different from Hamilton Avenue School in that Hamilton Avenue School was paid for through the mill rate. So that's the starting point. I have the authority to borrow up to these amounts. So I move to column 2. Column 2, I would go around in this situation and go to each department head that was responsible for each one of these capital projects and try to get a cash flow. And based on their information, I would borrow the amounts that are listed there. And for the 7-8 year, we borrowed $45 million in short-term notes, known as bond anticipation notes. So as we move along, we have a requirement by the IRS, which is monitored by Bond Counsel, that we have to spend down within certain amounts every 6 months. It's 25% after 6 months, 45% after 12 months, 75% after 18 months, and then after 2 years, you have to expend 100% less retainage of the amount you borrowed at that point in time, this being January 15th, 2008. The column to the right, which is the spent column as of November 13th, represents about $46 million in change, which means that we've covered the whole 2-year period, and we haven't violated the IRS regulations covering arbitrage, spend down. Now, This can also be used as a management tool, and it gives you, by going out with notes, flexibility. If we had started out and we had a requirement where I had to borrow with the bond issue, I can show you where it's flawed and it doesn't work. If you go to the Nathaniel Witherall line, where we borrowed $5 million, you can see in column 3 that we spent $462,000 to date. So we haven't spent enough, and we would have violated the IRS regulations for not spending enough, and I would have borrowed $5 million, which we would have been paying debt service on, and with the potential that the project may have never occurred. So we were locked into that. That's where the bands or the notes gives you flexibility. And what I can do here, and what I did here, was I have a project right below it called Glenville School, where I borrowed $9,961,000, but they spent $18,748,000. By communicating with IBIC and Bond Counsel, which is Robinson and Cole in this case, I can reallocate the money I borrowed from the Nathaniel Witherall and give it to the Glenville School so that I meet the spend down requirements. Does everybody follow so far how I've gotten through column 3? Column 4 can be used for a couple of reasons. One, it's a management tool. For example, if you go down to the $779,000 unspent and the $118,000 unspent for imaging and GIS, it shows you where we're slow in projects. So the management oversight, being the BET or the finance department, can say, something's wrong here. We're not spending quick enough, and you might want to, in your roles as a financial board, call in the responsible department and say, what is the status of this project? Is it going to be completed? Why is it moving slow enough? Above and below it, you could see some drainage projects, but it gives you the ability to monitor the projects along with the bonding program on how these projects are doing. So you have this band issue, which is a year old. Then you go to column 5, the second year, which is January 15th, 2009, which is a combination of rolling over the first year bands and borrowing new money, which is $27 million, which is the reason why I put both pages on here, and you see where it goes down to the $72 million. So in year 1, you've got bands, and then you've got from the second year of the bonding program, 1 year of bands. So when you get to the column 8, in order for me to meet the commitment to the BET and the RTM, I have to bond the first $45 million, which I'm going to do in January. I'm sorry, 6, yes. So what we're doing in January 15th of 2010 is I'm going to bond the $45 million we borrowed 2 years ago. Then I'm going to roll over the second year, which is the second year of bands, and then the third year of bands, which is the bottom number in the lower right, which is the $42 million, which is a work in progress, which will probably end up with $50 million. So as soon as we can get cash flow updates and expenditures to date in December for the information for the official statement. That's the basic bond band program for the town of Greenwich and how it works today. Let me stop here, and is there any questions as far as this document? And couple that with the presentation on what is a band, what is a bond. This is how Greenwich is applying it to the bond market.
Just a point of clarification I want to make. The items listed on here, other than the major items that you referenced, Nathaniel Witherall, Glenville School, and the sewer improvement, those items are selected every year based on the amount that we anticipate having to go out for debt service on, and that come up with a number. And the RTM has always pressed us for that list of items, but there's nothing in here that suggests, when you look at this, that we will forever bond for, say, asphalt paving. It just so happens that it's the combination of these projects that we've plugged in for that particular year to bond for, so that we can pay for other projects out of the mill rate, correct?
Yes, yes.
I
And
just want to make sure
also,
it's clear.
yeah, and also going back to column one, the four resolutions, the 24 million, the 7.3, the 22.9, they're specific to what your amortization or pay down period is. The 24 has to be bonded and paid down in 5 years. It's in the bond resolution. The 7.3 is 20 years. It's in the bond resolution. The Glenville School is 5 years, and then the sewers are 20 years. They're specific, and that's one of the reasons why we split these bond resolutions up.
Mr. Kelly, Mr. Campbell.
I was really good up to column 4. Column 5, if you can go back over that, we issued the one band of 45 million on January 15th, 08, correct?
Yes.
Then we're rolling that over January 15th of 2010, right?
Yes.
And then I lost you when you started talking about the 72 million.
Okay. That's where it gets complicated. If you could understand this, how I'm going to answer this, that's the way this program works. You drop down to the 208, 2009.
Right.
The second year kicks in, so you've rolled over the 45 million above, and then you've got the program in its second year kicking in, so that you've got new issues coming in. The second year, it's the first year of the note issue. So you're going to restart the process for the second year, but you have to combine them. So the first year is band, bond. Then 1 year later, you start again. You go band, bond. So that in the column that we're talking about, you've got 45 million from the first year, and then you've got 27 million from the second year.
Where's that 27 number?
It's the leftover from above added to the 19.4.
Oh, okay.
You can see,
all right.
for example, Glenville School. You see how Glenville School kicked up 8 million from 9,961 to 17.
I see how Glenville School had 22.7.
Yep.
The band was 9. They spent 18. So there's 3.9 left to spend, authorized to spend.
Then you go to column 5.
Okay.
It kicked up 8 million. So that's one example. That's going to be
You
added.
say kicked up 8 million.
It went up. We borrowed 8 million more between the reallocation. So when you asked where's the 27 million,
Right.
there's a yes. The term is that you have the new money is the 19,411,000, which is the bottom right above 72, and then because of the slowness of some of the projects, we're reaching back into 278, and you have to look at it and go horizontally across to find the differences, and then they'll foot down to the 72. So the 45 is renewable, and 27 million is new money.
I think what might be helpful,
I have the
Going
45. I have
forward.
the 45 million is the renewable. That's the 19.4. I have that number above the 72. That's the new money, and now this rollover money, is that the money that wasn't spent?
No, the 45 is just simply it's
I
rolled
understand.
over.
I understand the 45 million. I understand the 19 new to get to the 72. But now so the 8 million, Larry, is the extra for Glenville?
That's one of the pieces.
it's the 17 minus the 9. But here's one suggestion. If you could provide to the BET a breakout of the 72 where it came from that references back to this chart, I think that would be helpful.
I can show you right now. There's 3 pieces.
Go ahead.
There's the 19,411.
I got it.
There's the 17 that Larry just referred to. The difference.
It's the sum of the,
The difference between the 9.9 and then in Glenville School it goes to 17.
if you take the subtotals in column 5, the 24 million, the 5 million, the 17.1, the 6.3, and the 19.4,
Right.
that adds up to 72 million.
Okay, I could provide a. It's real simple.
It's there, but I think a separate
Yeah.
pulling that out I think would just be easier to go back and reference that. Because ultimately, you then have two of those that you just need to break out for the following year.
What? All right, I'm getting there. So, I mean, I got the 45 rollover and I got the 19 for new stuff. And then so we're missing the 8 million, which is the additional funding for,
No.
no? Okay. All right.
No.
I'll do a reconciliation.
I think that would be helpful.
All right,
You want us to, can you tonight?
I was close.
You're very close.
I just, simple explanations is, all right.
any
Okay.
other questions?
All right, so
on-
that's the 72, so then we go to the
Still
72.
with Mr. Kelly.
So now we issued a ban for 72 million. 11509,
Okay, so we're January 15th of this year.
right.
So what happens is, January 15th, coming up, 2010, I'm going to take 45 million of the 72 and bond it,
Okay,
okay? And I'm going to take the difference, the 27 million, which is going to be rolled over, and then we're going to repeat the process, and down below, 910, that's new money. And then again, you're going to need a reconciliation, because the difference between the new money is going to be the pieces that are slow in spending
right.
from the previous years. And again, that's a separate reconciliation. So I'll give you a reconciliation for year 2 and year 3 to tie to the 72 million and then to the 42 million.
No, Peter, this is a great start. It really is, or it's 90%, as far as I'm concerned, because it gives it a flow-through picture for me, so. I'm getting there.
I think I said Mr. Campbell and then Mr. Stone.
Yeah. I think I can remember my question. You got my attention earlier when you said that we would have had a problem legally had we not spent as much as we spent on Glenville School. I'm going back to the 07-08. And that is, I guess, we have grossly underspent, if you will, the $5 million from Nathaniel Witherell. So if that hadn't happened, is my question, if we hadn't managed to move so quickly through the Glenville School spending process, would we have had a legal problem on our hands?
It's a IRS problem. You have an option. You can you either rebate the excess earnings. We're in a negative arbitrage position, so it wouldn't be a problem. But in cases where if you borrowed at 4% and you were earning 6 or 7%, you would have to rebate the excess earnings.
Get a subsidy.
I'm fine.
Okay. Mr. Stone.
I'd like to fast forward a little bit, and this is for Mark. Mark, you're probably aware that out there is the possibility that the town will be approving an additional, let's say, $25 to $30 million in expenditures for the nursing home, which conceivably would be financed via the bonding route. And if you follow the cash flow that we're expecting to benefit from, there's no way that this is a 5-year payout. It's hopefully closer to 20 years. So I'm just wondering, today, what are the AAA rates for the town on a 5-year versus a prospective 20-year obligation, if we were to be doing it today? And we're talking about being a generation away. It could be as early as next year, but obviously it's months at best, and conceivably further away. And I think many of us are aware that the markets are very sensitive. There's a great deal of speculation that the Fed will be moving in the medium term, and that could knock the devil out of the various sectors of the market, and therefore whatever it is that you're saying exists today for a 20-year AAA could change dramatically. But if we were to go to market today for $30 million for 20 years, what would that cost us versus 5 years?
Well, based on what he said today, I'm not sure if they're talking medium term anymore. He's talking that they're probably going to hold where they are for, I think he used the term sustained period again, or something to that effect, and the market reacted favorably to that. But they'll be able to move quickly if they need to. A 5-year bond for the town, we've been pro-forming right around 2.5%. Effective rate, and for a 20-year, I think we right around, was it 3 3/4, 3.5?
I think, was it Richmond? He gave a 3.61?
Yeah, exactly.
Be about 110 basis points, I think.
Assuming level debt and cereals.
Correct. Yes, thank you. It's a level principal and serial payments. Correct.
Okay.
Principal, not level.
If we just go through the chair, just go through the chair, that would be appreciated.
I believe level principal, not P&I, but principal.
Okay. Thank you.
Mr. Simon, Mr. Norton, and then Mr. Huffman, if you have further follow-up.
Yeah, see, so I think the question that I thought you may have more of your presentation, but the question that we could face in January is whether to issue bonds for one more year. We don't have to issue bonds. And if you knew for a fact that interest rates were going to be exactly the same 1 year from now as they are today, what would you do?
I think we made a promise to the RTM that we would not go beyond 2 years with the bans. So
We could go, yeah, but we made a promise to the RTM that we wouldn't go beyond 5 years for bonds. We didn't necessarily preclude ourselves from doing bans for the next 5 years and amortizing 20% paying off 20% of the debt every year.
you're asking if we went bans for another year and draw down?
We could pay
1/5?
off some of the debt, do
You could do
bans, and then issue a 4-year bond. I don't think you can issue bans for another year and then a 5-year bond, but I think you could issue bans for 1 more year and a 4-year bond
That's an option.
that we have, and I don't think that violates any part of a spirit or an agreement we have with the RTM. Other people may disagree. But if you knew for a fact that interest rates were going to be exactly where they are now, you wouldn't want to pay 2 percentage points more when you knew you could get that same lower rate a year from now.
Or you could just simply roll over the $45 million and pay the debt down in 4 years instead of drawing down 1/5.
Well, I don't mind paying down 1/5 of the debt because I think you have to stay within the spirit of the 5-year bond.
Yes.
But I don't know that, and that's the question I have, is how would you decide what to do in January? You clearly want to take the financing course that's cheapest for the town.
I think to follow up to Larry's point, and Mark, correct me if I'm incorrect, it wasn't in the slide, but you can renew bans for 10 years. But after the 3rd year, you have to legally start drawing down 1/20th, or in our case, 1/5. So I think technically you can do the bans for all 7 years, and just as long as you haven't paid off within 7 years, and you still would be in the spirit of paying off the debt in 7 years.
Right. The only question is the interest rate risk you would take by not going out 5 years this year worth the 2 percentage points you would save by going out one more year with
That's exactly what it is. It's the risk of paying maybe 50 basis points for a note today versus the 2.5.
Correct. I mean, that's the $1 million question. We know rates are at an all-time low, probably going back to the 60s. So we're certain of that. We're not certain what next year is going to bring us.
So it's a gamble.
It's a policy decision. That's we deal with that every day with our clients, and that's I think also, Peter, correct me if I'm wrong, if we do issue the ban, if we roll the bans again, we have to make that 1/20th payment before we set. It would have to be this January.
Yes.
Versus next
Legally,
January.
we'd have to start drawing down 1/20th. But in our case, I think what Larry's saying, Mr. Simon is saying that we promised that we would pay the debt off in 7 years. It would have been ban in 5 years of bonds.
So you just structure
So-
it that way, okay.
We don't, yes.
Mr. Norton.
I think Larry just wants the 38 basis points that we got this year. Peter, I get a little confused with the advance for next January, the $1.5 million from Nathaniel Witherell. I thought I heard you to say that because we hadn't spent that money, that we were prevented from, other than reallocating it. Looks like we're going out and taking, funding it through a ban again. Am I misunderstanding something?
Yes. The 462?
Well, no, I'm talking about the 42,670,000 for bans for next January.
The 462 is going to be rolled over for a third year for bans.
You're actually,
462 is what they spent to date.
right, but you're actually going to fund next year $1.5 million
Okay,
again.
that's, again, like I said before, this is a work in progress, this column here. That's a cash flow estimate guess. I don't know, I need to know how much they're going to spend in the next 14 months.
Okay, so.
That's just simply a guess right now. This 42 million hasn't been solidified as far as cash flows.
Okay,
And
so
that could be 2 million, that could be 1 million.
so the ban number of 42,670,000 for next January is still undetermined.
Yes, it's probably going to max out around 50 million.
Okay, all right.
Mr. Huffman, did you have further questions for the?
I don't really have a question, but might have a comment. Doing one-year notes has had some interest rate advantage, but it has both a transaction cost that is not inconsequential each year, and also has some, obviously, interest rate risk that you take. And another thing that might be considered, and I don't know what you discussed, is whether in fact you should be looking in some cases at 2-year bans rather than 2 one-year bans.
Thank you. A further comment to my right. Mr. Stone.
Mark, just putting you on the spot. If we were to be making the decision today to go 1 or 5 years, and knowing that we'd have to refinance the 1 year, at least more than likely for an additional 4 years, what would your suggestion be today?
I would, because I'm not a gambling man. I'm in municipal finance. I'm by nature conservative. I know where rates are today, and I would recommend that you lock in at that rate.
Right.
And that is kind of, and also part of, it is what the plan has been. You kind of taking that into context as well. And the interest rate environment in a 5-year term is extremely low.
You have a sense, a very good sense to market conditions, and while I believe you say that they're much more settled than they were last year at this time, but putting it in the context of normalcy, is it still a very sensitive market that is therefore giving you a discount if you try to lock in rates today versus taking that exposure of doing 1 year and then refinancing it?
I would categorize the municipal market over the last year as very stock market-ish, very volatile. For instance, the September was the absolute low in municipal rates, and then the first 2 weeks of October came, and the market came up about 40 basis points. We're still at all-time lows, but it depends, and since that October time frame, the rates have come down about 10 basis points. So it is volatile, And it really depends on, if rates get to a point of absolute lowness, then the retail investors stop participating, and the rates tick up, and the retail investors then come back in. But it has been volatile, and we're not in the market of predicting where rates are. We just can tell you where they are now and give you some information, which is why we've been recommending, because the rates are so low, that if you can bond it, that's what our recommendation would be.
And a move or a statement by the Federal Reserve about some event that might take place could significantly impact the market?
I think economists in general, I'm not speaking for myself, I think they're saying that at the end of next year that the Feds will probably start moving rates. The assumption is when they raise short-term rates, the Fed fund rates, that the long-term rates go up. That didn't happen in 03 and 04 and 05, but that typically that's what happens. And the problem is we don't know what the future holds. If the unemployment stays where it is and consumer spending stays where it is, and then the Feds are kind of telling us that they're going to keep rates low. But
Mr. Norton.
Yes, Mr. Chairman. I'd like to reference the sheet that was included in the call for this meeting in regard to the GOs and the bans that we're going to issue, and we've tentatively scheduled for January 6th at Investment Advisory Committee meeting.
Okay. Question?
No, just information.
Oh, so that everyone is aware of it?
Yes.
Okay.
That's the day, if I read it correctly, it's the same week or day after, in which the rating agencies are going to opine for us.
Okay. Other questions? Mr. Kelly?
Peter, you mentioned we use two rating agencies, Moody's and Fitch. Do we need two? Can you just do one?
We're going to use 3 for the bond issue.
Why?
For
They
one,
cost
it's
money?
I think there's some members of the BET that desire us to go to all 3. It is more expensive,
What's
but
it cost?
you're the expert.
are we estimating? I apologize.
It's going to be a bond and a note, so it would be 15 to 20,000.
I believe so, per rating agency.
Per rating.
So we're paying $20,000 for each one of the 3 to rate us, AAA.
Yes. This is for 2. This is for both a bond and a note issue.
Is this necessary?
Yes.
A
your
minimum
record-
one is necessary. Traditionally, towns do at least 2. There's been a number of BET members that are requesting that we do all 3.
When do you make that decision?
We can make it tonight. It's I mean, right now we've been doing 2 with the note issues, but like I said, there's certain
We do it
members.
to assure the investors of the quality of the bond, correct?
Yes.
Yes.
I don't think any investor has questioned the quality of the Greenwich bond.
That is correct.
And I think we've been oversubscribed, right? I mean, we don't have any problem getting people to buy the bond.
No, exactly. The opposite is true.
So
the
why are we,
demand.
I don't understand the logic to spend the extra $40,000 on 3 rating agencies when one would do the job.
So let me ask it this way. If we decided to take this up at our December meeting, does that give you sufficient amount of time?
To choose one credit?
Or 2 or 3?
It should be. If I can just make one point, because of the economic tsunami that we all were embarked in last year, a lot of these investors, the funds or the institutional investors, have really tightened their internal criteria for purchasing of municipal debt or any debt, and they've expanded it and said, okay, minimum of 2 ratings on it.
Well, I think you can advise us at some point, or advise Peter, that in order to make the market for this particular bond, I'm recommending 2 because of the requirements that the purchasers have put in. So that's fine, but I don't want a knee-jerk reaction because 1 or 2 members of this board wants 3 to spend an extra $20,000 or $40,000. That's my point.
So going back, if we put this on our agenda so that there's full opportunity for people to discuss this prior to our meeting, is that sufficient enough time to make a decision at that meeting?
That'd be December 21st.
No.
Mr. Norton, if you can please go through the chair.
Are these dates firm? I apologize. I'm not the lead. My colleague Bill Lindsay is, and Peter, you can have those. Has January 4th been? Is that a firm date? Has that already been scheduled? I mean, we could cancel. I mean, we call them, I guess, on the 3rd and say, we're not going to use you. The 21st, I think it should be sufficient amount of time. And so it would be the 22nd would be that we would find out based on your meeting, and then we could call them and tell 1 or 2 of them that we won't be using their services. That should give us enough time.
Mr. Finger and then Mr. Norton.
Staying on the same topic, Mark, if we were to ask you today what your recommendation would be, whether it be 2 or 3, if you care to advise, again, I'm not looking to hold you to that, but just to get your recommendation based upon today.
And Peter, I'll defer to you and your conversations with Bill. Hopefully I'm not speaking on a line. He would probably have said 2, I think, but you can confirm.
2 at a minimum.
Right.
I'm not pushing the 3rd one.
We don't need to. We can do this.
We'll be taking this up on December 21st. In the meantime, if you have concerns or questions, funnel them through the finance department. If you can make sure that whatever questions are asked, they get sent to all the BET members in terms of their answers. I think that would be helpful. Discussion, if you have an element to this topic, let's stay on it for another minute if there are any issues with it, but I'd like to move on. Mr. Norton.
The only comment I would make is that the street regards the 3 agencies that are here differently. And 2 of the agencies, as I mentioned here, have higher reputations and are perceived differently on the street. And we're dealing with a combination of both bans as well as bonds. I think that the dynamics have changed as a result of strictly in the past we've been doing bans as opposed to our revenue bonds, which are the sewer bonds. So that there is some justification for including S&P and the rating agencies for these instruments.
Okay, we'll take that up in December. Further questions on topic 2 of the presentation? If not, we'll proceed to the 3rd part of the presentation.
There's a 3rd part.
It's a very good segue, by the way.
It takes a minute or 2 to warm back up. We have 3 slides remaining. These are the debt ratios. These are very important to the credit rating firms that we were just talking about. It also shows the future, where we are now and what we project out as the debt is going to be. The first slide is the debt per capita. We use 61,937 people as the population. All the statistics that go into these last 3 charts come straight off of Roland's 15-year financing schedule that was last released, and I believe it's attached to the budget guidelines. So you can see where the debt starts out. In all 3 cases, there's a hump there. What's important and what the credit rating people look at is that blue line above, which is the median for Connecticut AAAs. I think, how many, can you help me out with how many AAAs?
Correct, and that's from Moody's. We're using Moody's information. There are 12 Connecticut local municipalities with AAA rating, 10 of those in Fairfield County.
So So this is a very favorable graph when the credit rating agencies look at it. And this is a AAA benchmark against all the other AAAs on average. Next slide, please. This is the ratio of annual debt service to general fund operation expenditures. Traditionally, the 10% was considered moderate debt and was very acceptable to the credit rating agencies. There are a number of AAAs across the country that are reaching 15% and still are considered AAA. You can see where our debt starts out in the first. The 9 represents 9-10, and then the bonding program kicks in 10-11, and you could see where it starts to touch the 9% average of the AAAs in Connecticut. This is, again, a very acceptable debt limit. It's moderate, and there's nothing that leaps out that could damage the credit worthiness of the municipality. I believe the city of Stamford has a graph like that is touching on 15%. But then again, that's a town or city that borrows very heavily. Any questions on the first or second graph chart?
What percentage of general fund operations as of today?
Yeah, and that's with Nathaniel Witherall backed out. So we lowered. It doesn't include the debt from Nathaniel Witherall on either side, either the annual debt service or the expenditures. So if you look in the budget book doesn't really reflect the Nathaniel Witherall backed out because we made it. We voted on that, or the BET voted on that after the budget book was done. So, again, you back out the Nathaniel Witherall, and it's the debt service into the annual budget. And we use 3.5 straight line as an incremental increase each year as far as increasing the budget. And then the last.
And if I could just make one note on a national level. Populations of greater than 60,000 on the AAA, the median is 9.5%. So just to give you a flavor on where we are in Connecticut versus national and where you might peak at going out to 2018.
The final slide is the debt per
Peter, if we can, excuse me, Mr. Stone.
Peter, we know there's an elephant out there, and that is the Witherall, the possible Witherall borrowings. Have you worked numbers on to adjust this chart on page 24 to see what that would be?
You want us to hypothetically put the Nathaniel Witherall debt back into the general fund?
Well, project that there will be borrowings, let's say of a 20-year nature.
Okay, so you want in that chart the debt service to include Nathaniel Witherall and the Nathaniel Witherall budget.
The market clearly eventually will do this, and I think it makes sense for the finance board to know what it is that the market is going to be looking at.
We can do that, sure.
Mr. Finger.
Peter.
On slide 24?
Yes. The sewer debt, is that included in that slide?
No. This is general fund only.
General fund only? Okay, so, and also in the projections going forward as we continue to borrow, there's nothing in there for, right now in our 15-year model, we don't have anything or much for sewer, for drainage, is that correct?
That's correct.
So drainage, if we do anything in bond for that, that would be added, correct?
Yes.
Okay.
And then going back to Mr. Stone's request, this also represents, can you go back one?
You can talk
okay,
about it. We all
anyway,
have it in front of us.
The second to last slide, Nathaniel Witherall is going to be inserted at the request of Mr. Stone. That's 20-year debt. If you convert it to a 20-year amortization or even 10-year, that would dramatically drop below the 9%. So I just want to make that clear that that hump that you see there represents 5-year amortization. I don't think any other Connecticut municipality does 5-year amortization.
No, the most rapid is 10 years.
That's a little misleading in that we could have smoothed that out, but that's not what we do.
Okay, so I guess I didn't understand that. So the withdrawal debt is in there, but not on a 20-year?
No, it's not.
Okay.
This is general fund only, amortized over 5 years,
Okay. But
from the 15-year financing schedule.
Okay, I'd be interested, I think others might be as well, to see what finally will show once you plug withdrawal in, even on a 20-year basis.
The last schedule, please. This is the highlight of the credit review each year. I'll ask Mark, this is an amazing statistic. It's one, it demonstrates the town of Greenwich's ability to pay. We've got the largest grand list in the state of Connecticut. I think nationally, where would the national figure be on that blue line? It's
like 2%. I was looking at I was actually looking at where you stood up against communities greater than 60 to say 100,000 in population, and with your grand list, there's no one that really comes close. The only other community that's even close per capita is Chatham, Mass, but they're only 6,000 population, so it took them out of the formula. That really does tell the whole story from a rating perspective, and I can get you I apologize. It was such a low number. I didn't even want.
Yeah, it's just that's a highlight when we do a credit review. It helps us with the AAA. It's not the grand list that you see in the budget book. It's the equalized grand list, which probably start out, I think it's around 48.7 million as a start, and $1 billion instead of the 31 million or so that you see in the budget book. So basically, that's the presentations, part 1, 2, and 3. Is there any follow-up questions to the first, second, or third part?
Excuse me, Peter. I did have the number. I'm sorry. It's 2.4% for population greater than the AAA nationally over 60,000.
I think what you've heard tonight are a bunch of series of follow-up questions. We know we're looking out for some breakouts of the documents in the Excel spreadsheet that was provided. I think you've heard some comments regarding both Nathaniel Witherell and potentially sewer debt, as well as potentially for what we do with storm water management. And so I think those are the elements that are going to be further discussed, not only in the coming months, but certainly by February. And we have some decisions to make relative to financing of our drainage issues. So I think if someone does have a follow-up to Peter's presentation here today that wasn't stated here tonight, simply get it to Peter. And I think it was a good presentation, not only from an educational standpoint on our side, but also for those who are watching and listening, members of the RTM who are going to be asked again, in all likelihood, to not only fund the projects, but to approve resolutions. So thank you for the presentation.
You're welcome.
Okay. Is there any other business to come before us this evening? If not, is there a motion to adjourn? So moved. Mr. Kelly. Second by Mr. Finger. Thanks.